Within the next 36 hours, your opportunity to get first access at the Series A by just being a course member, which is like triple, quadruple value, goes away because the pricing will be substantially worse if you try to buy in the future. So try to get yourself into the programs on building your wealth before the end of the day of July 28th. We'll see you there. Have you heard of the Powell Curve? Well, this Powell Curve could be what determines whether or not the Fed ends up pushing us into a recession forcefully to bring down inflation or not. The Powell Curve is very, very important. In fact, the Powell Curve is Jerome Powell's answer to why we're not going to have a recession, or at least that's what he said so in March. Which what's very interesting here is in March, Jerome Powell said, "Fear not, we will not have the R word, no matter whether you define it via Biden's definition or how the markets actually view a recession, which is 2 quarters of negative GDP. We won't have the R word because fear not, the Powell curve is steepening." What do you mean potentially the Powell curve going down? My line is going up. And as long as my line is going up, we won't have a recession. Yes, folks, literally the Powell curve is Jerome Powell's excuse that as long as the line goes up, we are Gucci. And as long as the line goes up, the Fed should continue to be a little hawk and not a dove. Put those big boy pants on and talk dirty to us about how they're going to raise interest rates, make everything more expensive, constrain our wealth, and force demand down. Because by forcing demand down, inflation will go down, and then we can go back to printing more money in the future, which is what makes J. Powell happy. If you saw my Halloween video, you remember it was all about giving away money, because that's what J. Powell does. Anyway, he wants to go back to being happy. But right now, the Powell curve is going up. Or was it? Well, yes, it was. That was March. So what has happened to the Powell curve? And what even is the Powell curve? And why is it important for you to know about it? Well, again, it's important for you to know about it because it dictates how J. Powell responds. And Jerome Powell was right. Going up through March, the Powell curve has been doing this in a very, very dramatic fashion. Now I'm going to tell you what the Powell curve is, Powell curve, and then I'll talk to you about what it's been doing by showing it to you. So, the way you do the Powell curve is you simply take the 3-month Treasury yield. So that sounds fancy, but it's just basically if you put your money into a 3-month T-bill, what's the annualized yield that you're expecting from that bond? In other words, since it's only 3 months, you have to multiply it by 4, and then you get an annualized yield, right? Don't worry so much about that. What number is the chart at for the 3-month yield? And if that is at 2.5%, great, we got ourselves part 1 of the equation. Then we want to look at the 3-month yield 18 months out. And that's because people play in the futures market and go, we think Treasury yields are going to be at X% in 18 months on the 3-month. Annualized, of course. And if that number is 3%, then the spread or the distance between these two numbers is 0.5%. Well, folks, the difference between these two numbers has run up to in excess of 2.5%, roughly around the time Jerome Powell said, hey, my curve is still going up, which says no recession, and we keep on hike-a-doodling. Well, what has the curve done since March? Here you go, folks. This is the Powell curve. The Powell curve has plummeted and could potentially be at risk of inverting within the next month, which generally when the Powell curve inverts, as you could see what happened over here in early 2020 when the Powell curve inverted, we ended up having a recession within 18 months thereafter. Oh, and take a look at other times it's inverted. Oh, right before the dot-com bubble. Oh, and right before the 2008 recession. So no, it's not only because of a once 100-year pandemic, it's because economic and bond market conditions have aligned in such a way that when you get an inversion of the Powell curve, you could potentially have one of the most reliable indicators of a recession, even more reliable than that famous 10-2 inversion. Potentially because as the Powell curve inverts, it could be a sign that you're even closer to a recession than we previously thought. Now, we have not had an inversion in the Powell curve yet. You can see here we sit around that 50 basis point spread. However, because the Powell curve is falling so rapidly because of expectations of the Federal Reserve's actions and what the Federal Reserve has actually been doing, that is, they are literally starting to walk the walk rather than just talk the talk. Well, now we're starting to see an inversion, or the direction of a potential inversion, coming in the Powell curve. What's great about this is that the more we get the Federal Reserve walking the walk, the more the markets say, okay, well, we trust you now, you're going to do what you say you're going to do, we believe you, can we scale it back a little bit now, okay, can we just scale it back a little bit? Because here's the thing, no matter what happens at today's FOMC meeting, the big thing is going to be what's going to happen in September, November, and December. The markets have pretty much told us that today, July 27th, we are expecting a 75 basis point hike. That is going to bring us to a Fed funds rate of about 2.25, and the odds of this is sitting at about 73% right now. So we're pretty certain we're going to get this kind of hike. Then we get to about a 50-50 chance that we're going to get a 75 basis point hike again, and then a 50 over in September. And then in November and December, we're probably looking at either 50s or 25s. TBD, that so much doesn't matter right now. What really matters is the following factors, okay? This is what I want you to pay attention to. I don't want you to so much get confused by Waller and Bullard planning for a 75 basis point hike, or Esther George dissenting last time, going for a 50 basis point hike. That's not so much really what matters right now. Here is the exact list of, for the next 3 months, what you got to pay attention to when it comes to the Federal Reserve. Because remember, they're off in August, and they don't have a meeting in August. So we're not going to be seeing Jay Powell talk to us for, well, at least in the capacity of standing in front of the FOMC, Federal Open Market Committee. I'm sure he'll be having plenty of wonderful interviews to talk our market to death between now and then. So he won't be gone, but he won't be in front of the FOMC. But in the meantime, what is it that we're looking for from Jay Powell? Well, folks, number one is we want his reaction to the Powell curve. The reason we want his reaction to this is because if he says, okay, the market is telling us we've done our job, now it's time to do the famous old U-turn, that is going to be a huge buy signal to markets. Remember, markets have bottomed every single time the Federal Reserve has U-turned, whether that was in '89, in 2003, in 2009, at the beginning of 2009, in 2018, in December, or in March of 2020. All of these market crashes bottomed when the Fed U-turned. Therefore, if the Powell curve is enough for Powell to finally go, okay, yeah, my curve is no longer going up into the moon, it's time to U-turn because I want my curve to go back to the moon, then if he recognizes that, that would be deemed as bullish. So we want to see some kind of reaction to the Powell curve. Now that's going to be dressed up, so you're going to have to look for it, because you're going to hear them talk about the difference between near-term rates and futures rates. When you hear those words, near-term rates, futures rates, that is Powell curve talk, okay? Nobody's going to stand there at the FOMC meeting and go, so Powell, your curve looks like it's about to invert. Any kind of talk about the 3-month near-term and medium-term rates, that's what you're going to look forward to. Or even forward rates might be another way to say it, okay? Powell curve. Pay specific attention to this. Very, very critical today. Number 2, we want to pay attention to Jerome Powell's reaction to GDP data. Well, GDP data comes out tomorrow, which is July 28th, which is also the day the coupon code expires on the programs on Building Your Wealth. Live streams with me every day. The market is open when I'm in the office, and as much as I can when I'm traveling, which is very, very difficult sometimes, but I plan not to be traveling much anymore after this trip here. But anyway, awesome continued ad of beautiful fundamental analysis lectures, whether it's in real estate or stocks, and great discussions with the community there. So make sure to check out those programs. That coupon expires the same day as GDP data, which is tomorrow. Now, why do we care about JPOW and GDP data? Well, the reason we care about JPOW and GDP data is very simple, because Biden is trying to redefine what it means to be in a recession. He says, no, a recession is only called when the National Economic Bureau, Research Bureau, whatever, when these folks say it's a recession. The problem is those folks tend to take 14 to 14 months after a recession to actually tell you, yeah, damn, I guess we were in a recession. So the markets are like, we don't care about these morons at all. If we get 2 quarters in a row of negative GDP, we are technically in a recession. So take your definition and shove it where the sun don't shine, and we're gonna be in a recession. So stop trying to BS us. Why don't you actually talk straight to us for once? Oh, right, because you're a politician. Anyway, so GDP data comes out on the 28th, and obviously Jay Powell is having his meeting on the 27th, so we want to get an understanding from Jay Powell. Hey, Jay Powell, really gotta know, man. Do you think if we get 2 quarters in a row of negative GDP, we're going to be in a recession? And he's going to be like, well, yeah, you know, the textbooks have traditionally told us that that is the definition of recession, and that's generally what we're inclined to believe. Now, I don't know why all of a sudden I sound like George Bush, but whatever. We want to know his definition of GDP because that will also impact his response to the Powell Curve and the potential inversion of the Powell Curve. Next up, number 3. Oh, God. I'm coughing because this one's so full of BS. Yeah, we got to understand. Does Powell think that we're at peak? Peak CPI data. So CPI data thoroughly by the bond market is being told to have hit peak. And that's because consumer inflation expectations have peaked and are going down. Inflation expectations via the bond market have peaked and are plummeting. They're at the lowest levels that we have honestly seen in a year, which is remarkable. Commodity prices are falling. Copper, industrial metals like iron falling, nickel falling, lithium stabilizing. Wheat, we've got some drama here recently because of some rockets that came over to the Ukraine after a wheat deal between Russia and the Ukraine, but we don't need so much talk about this. The point is, if peak is behind us, and Jerome Powell admits that the peak is potentially behind us, it could be very, very Gucci for the markets. In fact, let's just take a look right here, okay? All right, this right here is what the chart looks like. You can see we are literally below where we were a year from now on inflation break-evens. And this chart usually plummets 3 to 4 months before the CPI falls. Yeah, I personally would be planning for the CPI to be coming down, and I kind of am. So anyway, this is important. These are the 3 important things that we got to watch for Mr. Jay Powell going forward, whether it's at the FOMC meeting or thereafter, along with that coupon code. And folks, we'll see you in the next one. Goodbye.